Welcome. This video covers one of the most requested trainings about trading the Traders Dynamic Index, an indicator used by thousands of professionals and retail traders around the globe since it was introduced in 2005. In this video, we'll cover 5 of the most successful trade strategies of the Traders Dynamic Index Pro, also known as the TDI Pro. Hello, this is Dean Malone, the developer of the Traders Dynamic Index Pro. I welcome you to this training and want to give you some background about who I am and why I developed the TDI Pro. I'm a registered broker, a member of the National Futures Association, and a commodity trading advisor. I've been interviewed by CNBC, Reuters, CNN, Wall Street Journal, and others, and I've trained tens of thousands how to trade the Forex market since 2002. I mention my background to let you know what I've experienced in the professional trading world, and I want you to have similar tools and strategies that the professional traders use. Even more, I want you to experience a greater simplicity in your trading. That's why I created the TDI Pro. Instead of having multiple indicators on your chart, the TDI Pro provides you the ability to see market sentiment, which gives greater insight into potential market movement. So what is market sentiment? Market sentiment is the overall attitude and perception of traders and investors in the market. For example, if market sentiment is bullish, then traders and investors are expecting upward movement in price. With that said, sentiment is often an indication of optimism or pessimism in the market based upon recent news announcements or political events around the globe. Before we get into the training, as a professional broker, I think it's important that you're fully aware of all the disclosures related to Forex trading and realize that your trading results may vary. No representations being made that any software or training will guarantee profits or not result in losses from trading. To start off our training, I think it's important that you have a good core foundation and understanding of the Traders Dynamic Index Pro. There are 5 lines in the chart. The green line represents current price sentiment. The red line is used as a trade signal line, looking for crossovers of the green line for entry and exit. The yellow line represents the overall market sentiment. With this in mind, we're going to be looking at the green line in relationship to the yellow line in many of the strategies. If the green line, representing current price sentiment, is making a strong move in a direction, and the overall market sentiment is either flat or moving in that direction, we have a higher favorable trade. And last but not least are the 2 blue lines. These represent volatility in the market. Is the volatility increasing or decreasing? Let me put it another way. What I like to often refer to is the market stepping on the gas? Just like with the car, if you're entering on the highway, you want to step on the gas. You want the car to get up and go. Well, the same thing holds true in the market. When I step into a trade, whether I'm trading long or short, I want to know that the market is buying when I go long and the market is selling when I go short. I want to know that other market participants are in the market and more people are buying and more people are selling. When that occurs, I have a higher favorable trade to reach the target that I intend for the trade to reach. Also, there are 3 levels with the Traders Dynamic Index Pro, and each one has significance. The 68 upper level line represents an area of what I refer to as buying exhaustion. Some often refer to it as an overbought condition. Anytime that the green line, the red line, or the yellow line start to approach the 68 level or go beyond it, I look for the market to potentially reverse and go short. Now the market, depending upon the time frame, may continue rising up above the 68 level, but eventually the momentum on the buy side will wane and the market will reverse and will fall back over. Just note that sometimes a move back over could only be a retracement, not a full reversal. The 50 line, this is the line that represents the difference between positive sentiment and negative sentiment. When the Traders Dynamic Index Pro green line and red line and the yellow line are above 50, we have positive sentiment. Buyers are buying. Whenever the TDI, green line, red line, and yellow line are below the 50 line, we're in negative sentiment. This is generally where sellers are selling. And then there's the 32, lower level line. This represents selling exhaustion. This is where sellers aren't looking to sell anymore. The price has gotten too low for them to sell anymore. And there's a higher probability that the TDI Pro and the market will start turning back to the upside. Why? Because sellers are getting out of their shorts. They're covering their shorts, buying back into the market, exiting their short positions. Now again, like buying exhaustion, that can wane and fall back over, selling exhaustion under the 32 level will happen as well, and we'll start to get this turn. But sometimes this turn is not a full reversal. Maybe it's only a retracement before the market turns and goes back short again. But these are the three levels and the reasons why we have the three levels in the TDI Pro. As we get into the training, these are the 5 most successful trade strategies of the TDI Pro. The TDI Signal, the SP Reversal, the TDI Hook, the Squeeze, and the Hidden Secret. With each one of these, we're going to look at the overall reason behind it, the specific components for each, and some trade examples. So you may want to take some notes along the way. The TDI Signal is a trend and angle strategy. We're looking for trend in a direction. We're looking for strong angle in that direction. That gives us an indication of strong, favorable market movement. Now, the beauty of the TDI Pro is in its simplicity to plot the direction of market sentiment in relation to price action. This strategy, the TDI Signal, is your everyday strategy for all TDI Pro users, whether you're a scalper, a swing trader, a position trader. In my experience, I've found to trade the TDI Signal, look to trade the green line crossing over the red line with good angle in the trend direction of the yellow line. The yellow line, again, is the market baseline, which is the overall market sentiment. If the overall market sentiment is moving up and the green and red line are moving up, we have a higher favorable long trade. When you break down the TDI Signal strategy, there are 5 components. Number 1, we look for a green line and red line crossover. At the crossover, look for a strong angle in the direction of the overall trend, the yellow market baseline. Compare direction of price and the Traders Dynamic Index green line. And just make note, whenever price and the TDI green line are moving the same direction, you have a higher favorable trade. And that's what this particular strategy is about, getting good trend with good strong angle in a direction. Now 4 and 5 are our entry and exit scenarios. So for our entry, we're simply looking to see that price action and the TDI Pro align. Again, price and the TDI green line are moving the same direction. We look to exit when the green line crosses over the red, blue, or yellow lines in the opposite direction. With these 5 components in mind, let's take a look at what are the requirements for a long trade, and then we'll look at a short trade. When considering a long trade, we want to look for the green line to have an angle between 12:30 and 2 o'clock. I've put the clock face in this training so that way you can have an idea of the angle that I'm looking for. What this represents to me is that if the green line is moving between 12:30 and 2 o'clock, there's a favorable possibility that price will continue in that direction. Also, we want to look for the market baseline, the yellow line, to be flat or rising between the 32 and 50 levels. And we want to avoid entering a long trade when the yellow market baseline is near the 68 level. The 68 level, again, is an area of buying exhaustion. And when we get up that high into what some refer to as an overbought condition, there's the higher possibility that the market will then fall back down towards the 50. Let's take a look at some trade examples. In this example, you can see that the green line has a strong angle between 12:30 and 2 o'clock, crossing over the red line and crossing over the yellow market baseline. Notice that the market baseline is flat and near the 32 level. This shows a lot of potential momentum to the upside, and that's what we look for when stepping into a long trade. This is a very favorable long trade condition. And when we take another look at the clock face, you can see that that green line matches up with an angle between 12:30 and 2 o'clock. as I said earlier, when we start getting up towards that 68 level, be cautious. The trade may not extend as far as we'd like it to. In this case, we have pretty good angle between 12:30 and 2 o'clock. The problem is, though, is that the market baseline is getting very close, near the 68 level, and there's that potential for reversal. As a matter of fact, in this example, we can see that shortly after the move up, the market did reverse and fall back over. Now, when taking a look at a short trade, it's just the opposite. We're looking for angle of the green line between 4 o'clock and 5:30 on a clock face. And we want that market baseline, the yellow line, to be flat or falling between the 68 and the 50 levels. And avoid entering a short trade when the market baseline, the yellow line, is below the 32 level, because that is where sellers are going to stop selling because the market has gotten too low. There's selling exhaustion, and the market will probably turn and make a move back to the upside. Let's take a look at some examples. In this example, coming off of what we looked at a moment ago, you can see that the green line is making a nice move down, and it has that proper angle between 4 o'clock and 5:30. One thing to be aware of is if the green line has a strong angle down towards 6 o'clock, be careful. You could get a strong retracement, a strong pop back up because of something related to the market. For instance, a strong move down could be because non-farm payroll report came out worse than expected, or an interest rate announcement came out unexpected. Any strong price movement will cause a strong angle in the Traders Dynamic Index. Also, you want to be cautious if the market has moved down too far. In this case, we're nearing the 32 level. There's a chance that at the 32 level, even though we have a good looking short potential to the downside, as we approach that 32 level, there's a possibility of the market bouncing back up. One last thing I want to share with you about the TDI signal is how to read the TDI signal related to one particular time frame, and that is a 15-minute chart. On a 15-minute chart, I found it quite interesting over the years that the green line represents the current price action. That's true across the board for all time frames. The red line on a 15-minute chart represents price action on a 1-hour chart. If you go look at a 1-hour chart and you look at the green line on that 1-hour chart, then go back over to your 15-minute chart, the red line on the 15-minute chart is going to be similar to the movement you see in the green line on the 1-hour chart. Also, I found it quite interesting that the yellow line represents price action on the 4-hour chart. So if you go over the 4-hour chart, take a look at the green line on the 4-hour chart, the movement of the green line on the 4-hour chart is going to look similar in many respects to the yellow line on the 15-minute chart. So why am I telling you all of this? The TDI Pro has the capability of giving you information related to multiple time frames. So the green line represents current price action on the 15-minute. The red line represents current price action on the 1-hour. And the yellow line represents current price action on the 4-hour. So with that in mind, if the green line's moving up, the red line's moving up, and the yellow line is tilted upward and starting to move up, you're in for a highly favorable long trade. The next trade strategy that we have for the TDI Pro is the SP reversal, which means the swing position reversal strategy. This is designed more or less for swing and position traders, those who have a longer outlook in their trading. The SP reversal is a counter trend type trade. Let's talk about that for a moment. The market tends to cycle up and down in a normal trading range the majority of the time. And at times, the market will make extreme moves beyond its normal range. And we often refer to this as overbought or oversold. And when the market's in these extreme areas, there is an expectation for the market to move back or to make a reversal into its normal trading range. So therefore, traders are looking for reversal trades. When it comes to the TDI Pro, we're going to be monitoring the yellow market baseline on a 4-hour or daily chart. And when the market baseline hits or extends beyond the 32 level or the 68 level, we're going to look for a reversal trade setup that could run for days or even weeks. Let's take a look at each one of the details related to the SP reversal. When it comes to the SP reversal, we're going to be monitoring a 4-hour or daily chart. And we're going to be watching the yellow market baseline as it approaches and hits the 32 level or the 68 level, and continue to monitor it if it goes beyond either one of those levels. And then what we're going to be looking for is the yellow line to turn, head back towards center as it crosses back below the 68 level and closes below it, or closes back above the 32 level. Now this is an indication that it is time to start trading in the direction of the reversal. And we're going to compare price action to the TDI Pro to make sure that price is following. Remember, what we're looking at here is market sentiment. And not always does price follow market sentiment. Price gets stubborn and will continue moving in a direction until there's no more buyers willing to buy that high, or no more sellers willing to sell that low. That's when we start getting a turn in the marketplace. So we want to be aware of that. We're going to enter a trade when the green, red, and yellow lines cross over in the direction of the reversal. And then we're going to exit our trade when the green line closes after the crossover of the yellow line. Let's go take a look at this a little bit more in detail. If you take a look at a daily chart, and I've compressed this one here, and I've removed the colors of the other lines and just focused on the yellow line, the market baseline, you can see the number of times that the market hit either the 32 level or the 68 level. And notice what the market does. As it hits up at the 68 level, like for instance, in our first circle over here, you can see that when it hit the 68 level, it made a move all the way back down to the 32 level and then started making a move up. Now notice that when it starts making a move up, not necessarily does price do the same. The price has a tendency to bounce around. Then the market makes a move up. You can see we're making a move up and we make a pull back down. And now notice that the next time we go higher above the 68 level. And then when it starts making a slight turn to the downside, you can see that the price actually made another move back up before continuing its descent down. And again, it descends all the way down to the 32 level and then back up to the 68, then back down to the 32. Now, all of this movement has been over days and weeks, but yet, at the same time, these are sizable trades. I mean, look at these moves. Can you imagine trading the CAD yen? It's up near the high here, and that's, let's call it right around 98, and it drops all the way down to about the 90 level. That's 800 pips. That's a significant move right there, just trading this one strategy. Now let's take a little bit closer in inspection of what this looks like as far as when we look to get in and we look to get out of the trade. In this chart, you can see that the yellow market baseline worked its way up to the 68 level, a little bit above it as a matter of fact, and rolled back over and closed below the 68 level. Look also that the green has dropped below the red and both are below the yellow. So we have a downward trend action taking place right now, and you can see that we can enter this trade at this area and trade it all the way to the downside. Now the question is, well, where do we get out? Depending upon your strategy, you could get out when the green line crosses back over the blue volatility band or back over the red line. Some traders prefer to hold in on this until the green actually crosses back above the yellow line. In this example, we're looking at a 4-hour chart with both a buy entry and a sell entry for the SP reversal. To the left here, you can see that the green line is over the red line, over the yellow line. You have a nice little move up in price. It'd be a good entry. The only caveat to this one is the fact that we did not wait for the yellow line to cross above the 32 level. Had we done that, well, we'd have to live through a little bit of up and down before it continued. So just be aware that if you have a good setup with the green and the red and the yellow turning and making a move, along with price action, again, comparing the two, looking for the same direction, looking for them to be aligned, that's a higher favorable trade. So there's a possible trade right there based upon this strategy. Now, come to the short, you can see that we hit the 68 here. Now, this was still approaching the 68, so not a good time to go short here, as this is still approaching. Let it go flat and then look for the next setup here that looks good. And that happens at this location, where the yellow's falling over away from the 68, and we have a nice setup right here. So somewhere in this area would have been a good short entry on this 4-hour chart. Our third strategy is the TDI hook. This is a counter trend strategy designed to catch intraday reversals when the market extends beyond the volatility band and either below the 32 level or above the 68 level. And the name of this strategy comes from the bending curve shape of the green line, much like a fish hook, as it moves back towards the 50 level. And one thing of note, the TDI hook is a built-in alert with slanted green and orange arrows. Green arrows represent a TDI hook long, and the orange arrows represent a TDI hook short. Now, when we get this alert, remember this is a counter trend strategy, so it's important that we monitor the yellow line for the overall trend sentiment and be watchful for price continuation before a reversal occurs. Remember, price can be stubborn. It can continue moving in a direction opposite the direction of sentiment. And eventually, if sentiment continues in its direction, price will turn. Let's take a look at some of the details of the TDI hook. What we're going to be looking for is the green line to move beyond the 32 level or the 68 level and be beyond the volatility band. So if the green line is above the upper blue volatility band and above 68 level, then we're going to be looking for a hook down or a hook short scenario. If the green line is below the lower volatility band line and below 32 level, then we're going to be looking for or expecting a hook up or a hook long alert. And we're going to monitor these hook formations. Again, a hook down if we're above the 68 level, or a hook up if we're below the 32 level. We're going to look for divergence or potential price continuation. If we get divergence, just be aware that sometimes the divergence is just a slight pullback, and then the market will continue in a direction. What we're looking for is a true reversal. So just be aware that we might get an alert, we might get a TDI hook indication, but the market may not be done just yet moving in that direction. We're going to enter the trade with a tight stop loss just above the previous high or just below the previous low. Exit the trade at the green and red crossover or a Fibonacci level or at the stop loss. On this chart of the Aussie dollar, you can see that we have a TDI hook long, yet price continues lower before the reversal up. And this is something you got to be aware of. Here we get the hook up. We can see right here that the blue line has come down. It broke below the lower blue volatility band. It's below the 32, and it hooks up and crosses. And when we get that crossover right there, that's when the alert is triggered. However, in this instance, you can see that price came back down, dropped a little bit lower, formed a double bottom, and then it made its move up. So just remember that when you get this alert, not always will the market make an immediate reversal. Now on the flip side, it did make an immediate reversal up above. You can see here we have a TDI hook short, and notice that the price and the TDI are aligned for a reversal down. We have a beautiful look right here. The alert is triggered when the green line crosses the upper blue volatility band and then makes its move down. When it crosses right here, we get the alert, and just about another candle or two more, we get the green dropping below the red line, and we have this nice move to the downside. Both price and the TDI are aligned for an immediate reversal. So in this one snapshot, you have both a price continuation, then the reversal, and then you have an immediate reversal. Now let's take a look at what divergence looks like. In this case, we have hidden bearish divergence. Whenever you have dashed lines showing in the TDI and on price, this is hidden divergence. In this case being pink, it is hidden bearish divergence, and we're looking for the price to make a move to the downside. You'll notice that down below we have no divergence showing in the hook up alert, but in the hook down or the hook short alert, we do have divergence. This is like a dual confirmation. Divergence suggesting downward action, and at the same time we do get the hook short alert and price follows. Now it gets a little stubborn again, tries to make a little bounce up, which is okay because this is a declining double top and we get continuation down. In this instance, we have both the TDI Pro and price aligned going the same direction. So again, in this instance, we have divergence indicating downward action. We get a hook short alert. We have dual confirmation of downward action. In this chart, we see hidden bullish divergence. Again, we get a dashed line showing up on both the TDI and in price. In this instance, we're looking for a move back up. So we look for the turn here, but again, as price comes back over, here you can see that this is the divergence. Shortly after the divergence, we get the hook long alert. And notice again what price does. Price makes a little bit of move up, then comes back and tests, and then makes the move up. So again, when it comes to this hook alert, be aware that the market could turn back and continue in its original direction before eventually making its move. But nonetheless, this is a good alert, dual confirmation, both hidden bullish divergence and the hook long alert. I often have folks ask me when they're in a trade, where do I get out at? What am I looking for? What should be my target? One of those targets can be a fib retracement. In the case of the TDI hook, we're looking at a reversal. So you could be looking literally at a fib retracement as a target. In this instance, you can see that the TDI hook short alert comes out and we have a nice move to the downside and it goes all the way down to a retracement level of 61.8. Look for each one of these levels to be an area to potentially exit your trade, be it the 23.6, the 38.2, which is a standard profit taking, the 50 level and the 618 level. Just be aware that oftentimes traders will try to step in at those levels and try to push the market back up. In this case, we had the market come all the way down to the 618, a nice retracement in this case. In this example, we have a situation where the market continued its reversal and it made a very strong reversal. You can see here that it actually breaks below this previous low and makes a move all the way down. In this case, we're going to be looking at fib extensions. I simply turn my fibs around the other way and then I look for them to move down to certain levels. The 127.2, the 1618. In this case, we made a move all the way down, a 200% fib extension move from top to bottom, given from this swing low to this swing high. So when it comes to looking for a target with the TDI hook strategy, look for a Fibonacci retracement or a Fibonacci extension if it breaks the previous swing low or the previous swing high. Our next strategy is the squeeze. This is a breakout strategy. The squeeze strategy derives its name when the blue volatility lines, the upper and lower volatility lines, compress or squeeze together due to price consolidating into a tight, narrow trading range with low market volatility. The location of the volatility band squeeze most often determines a favorable trade direction. So what we're going to be looking for is when the squeeze occurs near the 68 level, we're going to look to trade short. If the squeeze occurs near the 32 level, look to trade long. If the squeeze occurs near the 50 level, be aware of any economic events that can influence the direction of price action. What we're going to be looking for is the blue volatility lines to compress or squeeze together. We're going to identify the placement of the green, red, and yellow lines to determine the potential break direction. Now these three lines should be inside the blue volatility lines. And you're going to monitor the movement of the green and red line inside the blue volatility band for a potential break direction. Enter a trade when the green line breaks one of the blue volatility lines in the direction of the red or yellow lines. More often than not, the break will occur in the direction of the overall trend identified by the yellow market baseline. You're going to exit the trade when the green line crosses the blue volatility line, moving back towards center. Let me give you an example of what it looks like on a chart. In this example, we're looking at the squeeze high. Notice that the squeeze is occurring around the 68 level. Well, this is kind of a no-brainer. When we get a squeeze up this high, it's highly unlikely to see it push any higher. More times than not, it's going to make a move down. It's a beautiful setup to catch a move in an almost predetermined direction. So we're going to expect a reversal down with the yellow line near the 68 level. We're going to look for the green below the red and below yellow. We're going to enter on a break of the low blue volatility line, and we're going to exit when the green line crosses above that low blue volatility line. You can see it all come together right here. You can see when the market broke down right here, and then finally we get the break right here. And a nice move down, takes a little bit of a bounce, and then comes back over. This is a prime area to potentially exit the trade. I think by now you're getting an idea that you can literally trade the Forex market without even looking at price when it comes to the TDI. The TDI does such a great job of identifying and plotting the current sentiment in the market. And generally, more times than not, you're going to have price following the direction of sentiment. Let's take a look at another squeeze location. This is the squeeze low. Just opposite the squeeze high, look where it's at. It's down there by the 32 level. And again, we're expecting more than likely for a reversal back to the upside, because it's highly unlikely it's going to try to make another move down, but it might if there's an unexpected economic announcement. So what we're going to be looking for here is an expectation of a reversal up with the yellow line near the 32 level. Look for the green above the red and above the yellow. Enter on a break of the high blue volatility line, and then look to exit when the green line crosses back below that high blue volatility line. So you can see everything coming together in this little area. You see that we're down low, we come back up, and we're getting this crossover right here. Notice how the blue volatility bands are squeezing down tight. Here's our break right there, and market makes a move up, and then our exit is right there where we can exit the trade. Now the market did go flat here and make another move up. So let's say, for instance, you could exit right here, or look at price for a place to put a stop loss or a trailing stop loss and look to see if the market continues making its move on up. Now let's take a look at the last squeeze location, and that is the squeeze center, the center of the TDI Pro near the 50 level. Now this one can be a bit tricky because it can move up or down. And so what you'd want to do is you want to monitor any economic events in the marketplace. Oftentimes I found that the market really compresses down, really tightens down, squeezes down into a tight, narrow range just before a large economic news event like non-farm payroll or interest rate announcement. So you need to evaluate the result of that economic event and look at the overall trend of the yellow line to determine the potential break direction. Oftentimes, because of that announcement, we may get a strong break. So you want to be aware of that. If there's a strong break, then look for any retracement back towards the squeeze area in price and then continuation. Like the other two, we're looking for a break of the blue volatility line to enter the trade. In this case, it could be the upper or lower blue volatility line depending upon the direction of the market. And you're going to exit when the green line crosses inside that blue volatility line. So in this case, we can see that the market broke down, an entry point in this area, and then we get this move down, and then we can get a potential exit right there, coming back in. I have found that the squeeze strategy is a great strategy to look for. Whether you're trading the squeeze high, the squeeze low, or the squeeze center, it's an excellent strategy to be looking for a breakout and a potentially good trade. Last but not least is the hidden secret. I refer to it as the hidden secret because a lot of traders miss it. They don't see the possibility of what this strategy does for them. See, with any good trading model, there should be a strategy to ride the momentum of the market as far as that momentum will take you. The hidden secret of the TDI Pro is a trade setup that identifies where to enter and where to exit to ride that momentum trade. The beauty of the hidden secret is that it can be found in all time frames and often occurs following a squeeze trade setup accompanied by a strong economic event affecting price action of a currency pair. Shortly after a squeeze condition or a strong economic event, look for the green line to make a strong angle while breaking one of the blue volatility lines. The angle of the green line, if you think back at the clock face, it should be between 12:30 and 1 o'clock for a long trade, or between 5 and 5:30 for a short trade. Enter the trade when the green line breaks the blue volatility line. Enter long preferably if the green line is equal or less than the 50 level. Enter short preferably if the green line is equal or greater than the 50 level. And then you want to exit the trade when the green line crosses the blue volatility line in the opposite direction. Let's take a look at the hidden secret on a chart. When you look at this chart, look at the rectangle. Look at the price action inside the rectangle and look at what the TDI is doing inside the rectangle. This is what we're talking about. Being able to catch a move literally from the entry point right here where the green line is near the 50 level and breaking the blue volatility line. And holding in on this trade, regardless of what price is doing up and down right here, hold into this trade until the green line comes over and crosses the blue volatility line. That is the hidden secret. That is being able to ride the momentum of the trade as far as it can go. Now, if you look at price starts to top out a little bit right here and then falls back over. When it falls back over, it makes one more push back up, giving you a declining double top and then finally drops. In this area, you can exit the trade. So you're not getting out at the very top, but you're getting out very close to it when you look for that green line to cross the blue volatility line. Let's look at this a little bit more in detail. When we take a closer look at the entry, what we want to find is that the green line is breaking above the blue volatility band. And we want to see that the green line is crossed over the red line and preferably above the yellow line. Notice that the yellow line is flat here and slightly rising up. Those are indications of a long trade. Now the important thing is that we want to see that both price above and the TDI are trading higher after the break of the upper blue volatility band. When it comes to the exit, as I mentioned a moment ago, we're going to be looking for that green line to roll back over and cross the blue volatility band. It's not nearly as important to cross the red line because the red line may not be up as high as it is in this case. But what we're going to be looking for is that green line crossing back below the blue volatility line. This puts our exit near the highest point of the trade. Taking a look at the hidden secret in a short trade scenario, you can see inside the rectangle that price action had a beautiful move down. We had a very strong movement down, long movement down in the TDI Pro. Again, we're looking for the green line to be right around the 50 area and breaking that blue volatility band. Notice that the blue volatility band squeezed right near the center and we get a nice breakdown, probably due to a strong economic announcement. So we get this immediate move down in price, and you can see this immediate break here, and then there's just a continuation. Oftentimes I'll take my eyes off of price and I'll just watch the TDI. And when the green line of the TDI crosses back inside the blue volatility band, that's when I'm looking to get out of my trade. And that was almost at the bottom of the trade. The trade made a little bit more of a move down right here and then made a bounce back up. This is a trade that went from about the 214 level all the way down to below the 211 mark. Beautiful trade right there for about 300 pips. Looking at the entry, we can see that the price and the TDI are both turning down, the green under the red, under the yellow preferably, and breaking the blue lower volatility band. So we look for price and the TDI to trade lower after the break of the lower blue volatility line. At the exit, again, I'm looking for the green line to rise back and cross back above the lower blue volatility line. This completes the training of the TDI 5, the 5 most successful strategies for trading the TDI Pro. Now, as you learn more about the TDI Pro, you're probably going to find some additional strategies. But these are the top 5 strategies that have been used by traders around the globe. My recommendation is to find one that resonates with you. Remember that the TDI signal is the everyday trade strategy, so you might want to start with that one. If you're a position or swing trader, you might want to consider the SP reversal, focusing your attention on that yellow market baseline. And if you're looking for intraday reversals, monitor that TDI hook. The alert is built into the TDI Pro, but be careful when you're looking for intraday reversals because price is stubborn and may continue moving before you get the reversal. For me, one of my favorites is the squeeze because we're looking for a breakout. Whenever the market tightens down, especially with a squeeze high or squeeze low, there's a higher probability that we're going to get a good reversal trade. And then there's the hidden secret, which often follows a squeeze trade condition. Look for a continuation of the green line of the TDI to literally move from almost one side of the TDI to the other side, and you're able to ride the full momentum of the market. Well, this is Dean Malone with Compass FX. I hope this training of the TDI 5 strategies will help you in your trading. Make it a great day and get some good trades.